2022 has been a bad year for investors, and with 2023 finally here, I wanted to make a few predictions as to what I think might happen to the stock market this year. Then, at the end of the year, I'll be going through this list to see how accurate my predictions are. Take note, this is just a fun prediction. I'm not saying all this will definitely happen. Also, a huge thank you to Phillip CFD for sponsoring this video. But more on that later. First, inflation will slow down faster than expected. Right now, the inflation rate is still at 7%, which obviously is still quite high. Though, prices are now finally starting to come down. Energy prices are declining. Used car prices are coming down. That's remained stubbornly high is the shelter cost. But because shelter cost typically lags by 4 quarters, we should be seeing shelter costs coming down in the first half of 2023, which will bring inflation down further. Not only that, personal savings rate will continue to remain low, consumer sentiments staying low, loan interest rates going up, and a possible recession happening. All this will cause consumer spending to remain low. Because of that, I believe that the inflation rate will slow down faster than expected. Second, the Fed will not cut interest rates this year. As of making this video, the federal funds rate is at 4.25 to 4.5%. And as you all know, the whole reason the Fed is raising interest rates fast and furious is because they are trying to catch up to this high inflation. This year, however, they will likely start slowing down rate hikes to either 25 or 50 basis points each meeting. In the last meeting, most of the Fed officials believe that the rate should be increased to around 5 to 5.25% in 2023, which means that they will reach the target rate by the third meeting in May. Now, according to the market, it is currently expecting that the Fed will start cutting rates by the end of this year, which is in line with history, where in the past, the Fed has on average started cutting rates 5 months after the last rate hike. But personally, I think that this time the Fed will not cut rates so soon. They will want to wait for the inflation to stay low, not just low, but convincingly low for a few months before they start cutting rates, which will mean that I'm expecting the Fed to only start cutting rates by early 2024. Third, a recession will finally come this year. With the yield curve inverting for a while now, a recession is very likely to happen, though I think that it will just be a mild recession. Right now, the unemployment rate is still quite low at 3.7%. Even though the Fed expects the unemployment rate to go up this year, they are only expecting it to go up to 4.6%, which is still low, especially when you look at past recessions, where the unemployment rate goes up to above 6 to 7%. At the same time, non-farm payrolls are still increasing and the job market is still quite strong. When you add up all these signs, when a recession does finally come, it will just be a mild recession, nothing too scary. Next, China market will outperform the S&P 500 in 2023. If we look at the China market, it has basically been falling since 2021. Painful, yeah? All this was caused by a ton of reasons, like the COVID-0 policy, property crisis, the government clamping down on private tuition companies and tech companies. And the most recent news, the president has extended his 10-year rule. But here's something interesting. After this news came out, the market found a bottom and started going back up. Not because the market likes all this news or anything, but rather there's no more uncertainty. The market be like, clamp down President continue being president First time? They've already priced in all the bad news. And going forward, it does seem like the worst is already over. For now, China is starting to open back up, ease up on the crackdowns, and even allowing Ant to continue their expansion plans. Meanwhile, US, on the other hand, is expected to enter into a recession. More people will lose their jobs, interest rates will continue to rise, companies will start missing earnings, and the S&P 500 is still overvalued now. Because of all these reasons, I expect that the China market to outperform the S&P 500 in 2023. Today's video is sponsored by Phillip CFD, one of Phillip Securities' business outfits. Besides investing in the usual stocks and index funds, Poems also lets you invest with both your CPF and SRS money, and at a very low fee. For the experts, Poems also offers sophisticated products like CFDs, warrants, unit trusts, forex, futures, and more. Right now, Poems is running a Chinese New Year promotion where if you sign up now and opt for a CFD account, you'll get a $5 PlayMade drink voucher and enjoy $88 of CFD trade rebates. It only takes 3 simple steps to sign up. So easy! On top of that, if you opt into CFD trading, fund $1,000 and execute just one CFD trade, you'll get 6 chances to win a 3-day, 2-night staycation at 115 Marina Sentosa Cove. So if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. Next prediction, S&P 500 will continue to fall for a while more, finds a bottom in 2023 before coming up a little. As people cut back on spendings, many companies are going to have lower earnings this year, which means that the stock market will continue falling. So I definitely wouldn't think that the market will fall below 1,900 points like Michael Burry predicted. And because the market is forward-looking, it will bottom much earlier before companies' earnings bottom, probably somewhere in the second half of the year when a mild recession finally comes, because historically, the market has never bottomed before a recession. Now, many analysts are expecting the S&P 500 to reach 4,005 by the end of the year, which is like 17% above the current price. But personally, I'm still doubtful. With the economy still weak, I believe the markets will end the year below the current price. Next prediction, Tesla will not do well in 2023. The stock has fallen by a lot in 2022. And in their latest delivery report, they reported lower delivery growth of 40%. Now, obviously, 40% delivery is still a very good number, especially in this current environment. But it is a clear sign that demand is slowing down this year. Yes, this lower delivery number is partly due to people delaying their Tesla purchase to 2023 to get the $7,500 EV tax credit. But this is just a one-off thing. And also, people are now finding out that the Model Y may not be eligible for the tax credit. So this EV tax credit thing will not boost Tesla sales by too much. Also, by next quarter, analysts are expecting that the growth will slow down even more to 30%. Then you might ask, what about the Tesla Semi which started deliveries late last year? There's no mention about it in the delivery numbers, which makes me think that Tesla feels that this number is too insignificant to be reported. What about the Cybertruck, which is expected to come out this year? They will start deliveries in the second half of the year, but they still won't be able to ramp up to a meaningful number by the end of the year. Though Tesla might launch a cheaper Model Y version by the end of this year, but I doubt it will be enough to increase the demand by too much. Because right now, with new car loan interest rates going to the moon, people are going to put off buying a car unless they really need to. In short, I believe Tesla will continue to do badly for this year, which unfortunately would mean that we might be seeing the stock continue to either fall or remain at current prices this year. Next prediction, Singapore T-bills yield will peak at around 4.6%. Common sense tells us that the higher the interest rates go, the higher the bond yields go. This happened in 2022, where the T-bill yield hit an all-time high of 4.4%. So by right, if the Fed is going to raise rates by another 1%, we should expect Singapore T-bill yield to go up by another 1%, right? Personally, I doubt that will happen because 1. The market is expecting the rates to peak within 6 months and start coming down. This means that T-bill yields don't have much more room to increase. 2. Most of the people who wanted to invest in fixed income investments would have already locked in their money by now. We can see that in SSB, where previously people could only get around $10,000 SSB a month. But in the latest month, the allotment suddenly goes up to $172,500. Demand is a lot lower now. Though, people who invested in last year's T-bills when rates were increasing will be getting back their money soon. so demand will come back up a bit. But I believe that some investors are now reserving their cash to prepare for the next market boom. Hence, overall demand for T-bill would be a lot lower, which would mean that T-bill could peak at around 4.6% before coming back down. So those were my predictions for 2023. As you might imagine, I'm a little bearish now. But let's see how many predictions that I got right by the end of this year. Anyway, that's all for this video. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.